Hello everyone and welcome to today's webinar titled Strategic Trading with Double and Triple Tops and Bottoms. My name is Ali Mortezavi and I'm the Head of Education at Toronto. I'm delighted to have you all here today as we dive into the exciting world of technical analysis and explore how to effectively trade using these powerful chart patterns. We'd first mention that this webinar is brought to you by Orante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. And before we begin, please note that the content of this webinar should not be construed as investment advice of any kind. The strategies and information provided are for educational purposes only and should not be considered as a recommendation to trade. Because trading CFDs carries a high level of risk and it's possible to lose all your invested capital. Please ensure you understand the risks involved and seek independent advice if necessary. Thank you. Okay, without any further ado, let's get started with our first topic and explore the basics of chart patterns and why they're so important for successful trading. Now that we have set the stage, let's begin by discussing the foundational concepts of chart patterns. What are chart patterns? Chart patterns are graphical representations of price movements over a specific period. They are formed by plotting the historical price data of an asset on a chart and identifying certain shapes or formations that appear repeatedly. These patterns are essentially a reflection of market sentiment, encapsulating the collective psychology of buyers and sellers in the market. When traders recognize these formations, they can interpret the potential future movements of the price based on how similar patterns have behaved historically. Okay, each chart pattern tells a story about the ongoing battle between bulls and bears, the buyers and sellers. For instance, a pattern that indicates buyers are unable to push the price higher despite several attempts may suggest a weakening uptrend, possibly signaling for forthcoming reversal. Conversely, a pattern showing repeated failure to push the price lower may indicate a strengthening uptrend. Understanding these stories helps traders make more informed decisions. The significance of chart patterns lies in their ability to predict potential price movements. By identifying patterns early, traders can anticipate and prepare for potential breakouts, breakdowns, or reversals, even allowing them to position themselves advantageously in the market. This predictive ability is what makes chart patterns such a powerful tool in the technical analysis toolkit. So in today's webinar, our primary focus will be in 4 specific chart patterns: double tops, double bottoms, triple tops, and triple bottoms. These are among the most reliable patterns in technical analysis, often signaling significant trend reversals. Understanding these patterns and how to trade them effectively can give you a considerable edge in the market. Additionally, we will discuss how to enhance these strategies using the Relative Strength Index, or RSI, and the 34 linear weighted moving averages, and this will help us confirm the validity of patterns and make more informed trading decisions. So by the end of this webinar, you will be equipped with the knowledge to identify these patterns and integrate them into your trading strategy using RSI and moving averages, helping you navigate the markets with greater confidence and precision on any time frame. So let's move forward and start by understanding double tops and double bottoms, 2 of the most common reversal patterns in technical analysis. Okay, what is a double top? A double top is a bearish reversal pattern. It signals a potential trend reversal from bullish to bearish, essentially. Uh, this pattern suggests that the market may be shifting from an upward trend to a downward trend. It's important to note that the double top is one of the most reliable reversal patterns and is commonly used by traders to identify potential selling opportunities. Let me just bring my MetaTrader, so that would be helpful, I guess. Okay, please let me know if you can see my MetaTrader on your screen. Okay, that's great. Thank you for your confirmation. Okay, so let's continue. It's important to notice that the double top pattern is characterized by two distinct peaks or highs that occur roughly at the same price level. For example, we can find uh, a couple of examples actually here. Something like this. These peaks are separated by a trough or let's say a pullback. To start, let's find a better example of that. If we move on a weekly chart, you can see a very, very famous double top pattern in Euro USD. Okay, I was saying these peaks here, for example, are separated by a trough at this level or a pullback that dips down to a support level like this level. The appearance of the two peaks suggests that the market has tried to push higher twice but failed both times, indicating a strong resistance level. Let's break down the formation of the double top. First peak, the pattern begins with an initial high, like here, where the price reaches a peak after an uptrend. After hitting this high, the price pulls back as sellers start to take profits or short the assets. Then, following the pullback, the price declines to a support level at this level somehow. And this is the lowest point between the two peaks and is crucial in defining the neckline of the pattern. After finding support, the price attempts to rise again and reaches a similar high to the first peak. However, it fails to break above this level, confirming the resistance and forming the second peak. This inability to surpass the first peak suggests that the buying momentum is weakening, setting the stage for a potential reversal. But to effectively trade a double top, it's essential to confirm the pattern with specific validation rules. Uh, Let me mention some of the most common rules here. First, symmetry. Both peaks should be at approximately the same level. The symmetry indicates that the resistance is strong and that the market has tested this level twice without breaking through. Then the pattern is only confirmed when there is a clear break below the neckline. So that's the way we can confirm this pattern here. This break should occur with increased volume in the stock trading, but not in Forex all the time, signaling that sellers have gained control and that a bearish reversal is likely. So we need a break out of the neckline to confirm the pattern on itself. The third one, which is more usable in stock trading, is volume pattern. Volume plays a critical role in validating a double top. As the second peak forms, the volume should ideally decrease, indicating waning buying interest. Conversely, when the price breaks below the neckline, the volume should increase, reinforcing the bearish reversal and confirming the pattern. So understanding these characteristics and validation rules is crucial for accurately identifying and trading double tops. While waiting for clear confirmation, such as a neckline break with increased volume, traders can avoid false signals and position themselves for successful trades. Now, let's look at double bottom pattern, which is essentially the bullish counterpart of the double top. So don't forget about the definition, about the formation, and about the validation rules, and try to pull them all together. Now, that we have covered the double top, let's move on to its bullish counterpart, the double bottom. A double bottom again is a bullish reversal pattern. It signals a potential trend reversal from bearish to bullish. This pattern suggests that the market may be shifting from a downtrend to an uptrend, indicating a strong buying opportunity. Like the double top, the double bottom is a highly reliable reversal pattern and is commonly used by traders to identify potential entry points for long positions. We can find a good examples maybe if we look through the charts. This time, let's shift our attention to another charts, maybe GBP USD or something, and let's go through it to find one. But before that, let's just yeah, I'm trying to find a good example of that. Yep, here's something. Could be, but it's not a very nice example of the double top of the double bottom if you are new to the market. So let me just try to find something more precisely fit to our definition, because that will be more helpful at the beginning of your journey to identify these patterns on the charts. Yeah, it could be a good one, I guess, on this daily chart. Let's move to, I'm looking for another good example here, something like this, which is a bit complicated, that we'll discuss the more advanced features. Yeah, I guess that was a good example that we can discuss about as a very nice example of a double bottom pattern here. So as you see, the double bottom pattern is characterized by two distinct troughs or market bottoms that occur at approximately the same price level, separated by a peak or a rebound, as you see. But here, identifying the peak is a bit tricky because we have the a strong resistance level, which a couple of candles trying to pierce this one. And the appearance of these two troughs or bottoms indicates that the market has tested a support level twice and failed to break below it, suggesting that this level is a strong support zone. And let's break down the formation of a double bottom. First trough, the pattern begins with an initial low where the price reaches a trough after a downtrend. We can identify the downtrend by marking this lower tops and lower bottoms here in the market. And if you want to have the first trend line, it can be this line. And then if you want to continue with the second one, as we see the formation of this market top here, we can draw another, or we can adjust our initial a trend line a bit, and then we can have this trend line. So the pattern formation is this first trough, peak, and second trough. So we have the pattern begins with an initial low where the price reaches at trough after a downtrend here. And after hitting this low, the price rebounds as buyers come in to support the asset. And following the rebound, the price rises to a resistance level like this. And this peak is the highest point between the two troughs or two market bottoms, and helps define the neckline of the pattern, this line here that we can draw at the level of this market top. And after reaching the peak, the price declines again and approaches a similar low to the first trough. However, it fails to break below this level. If I want to mark it, that would be nice to see the very, let's say, small distance between this market bottom and this the second bottom and the first one. However, it fails to break below this level, indicating a strong support and forming the second trough. This inability to break the first trough low suggests that the selling pressure is weakening, setting the stage for a potential bullish reversal. But here, we still need some validation rules on the ground. To effectively trade a double bottom, it's essential to confirm the pattern with the specific validation rules. First is symmetry, then it's neckline break, and then we can have a further confirmation using volume patterns in stock trading, but it's not actually applicable in forex trading because we don't have a real volume in forex. We just have a tick price. So for the symmetry, both troughs should be at approximately the same level, and this symmetry indicates that the support is strong and that the market has tested this level twice without breaking through. It's very important. And the neckline break, the pattern is only confirmed when there is a clear break above the neckline, which is very important. This horizontal line drawn through the peak. And this break should occur with increased volume for stock, signaling that buyers have gained control and that a bullish reversal is likely as we see a shift in the overall market sentiment. So again, please remember the definition, the pattern formation, and the validation rules. And we don't recognize any pattern as a double top or double bottom before we get this validation rule set on the chart. Moving forward, let's discuss the triple top pattern, which is an extension of the double top pattern we covered earlier. A triple top is a bearish reversal pattern, again, that signals a potential trend reversal from bullish to bearish, similar to the double top, but with an extra peak. And this pattern suggests that the market may be losing its upward momentum and is preparing for a downward reversal. The triple top is often seen as a stronger signal than the double top due to the repeated failure of the price to break through a resistance level, demonstrating persistent selling pressure. But here also we have some key characteristics of a triple top that can help us to recognize it or identify it in chart easier and correctly. The triple top pattern is characterized with three distinct peaks that occurred approximately the same price level, separated by troughs. Let me again move to my MetaTrader to see if I can find a bit illustrative example here. And if you remember, we covered the head and shoulders pattern in our previous webinar. And the triple tops and triple bottoms are mostly similar to head and shoulders. The only difference is that they usually don't, let's say, they usually have the approximately same mark tops and bottoms. Okay, so it is not a very, let's say, the textbook fashion example. However, we can name it as a triple bottom here. But let's let's see if we can find a good example of a triple top pattern in the market, in the current market right now. Or maybe if we move to another time frames here. Again, you see we have an example of a head and shoulders, something like this. We can name it a triple top. Yeah, if you take it easy, yeah, of course, we can name it a triple top. And as you see, we have three distinct peaks, 1, 2, and 3 that occurred approximately the same price level, separated by troughs. The formation of these three peaks indicates that the market has attempted to break above the resistance level multiple times, but failed each time. And that highlights the strong resistance zone for us. So we can mark this level as a strong resistance level. But let's break down a formation of a triple top here. The pattern starts with an initial high after a strong uptrend. So the first rule is identifying a prior trend here in the market. So we need to have a prior trend, should be an uptrend for a triple top formation. Because in absence of a trend, it's not a reliable chart pattern. So the pattern starts an initial high after a strong uptrend here. The price reaches a peak and then pulls back as sellers start to take uh, profits or maybe short the asset at this level. And following the pullback from the first peak, the price declines to support level, forming the first trough. Afterward, the price rises again but fails to break above the previous peak here, forming the second peak. We can name it the first peak and then the second peak, and you see we don't have a confirmed penetration of this level. As we see, the market just got to this level, but at the next candle the market reversed, and we see it's not a confirmed breakout. So it forms the second peak here, and this sequence repeats one more time, creating a second trough followed by a third peak, each time failing to break the established resistance level at this high. So the second and third peaks rise to similar levels almost as the first peak, indicating persistent resistance level. Each time the price reaches this resistance level is met with selling pressure that prevents further upward movement. And this inability to break through the resistance level demonstrates a weakening bullish sentiment and sets the stage for a potential let's say, bearish reversal. So the validation rules, again, is very important. The symmetry is the first one, as three peaks should be at approximately the same level. The symmetry reinforces the idea of a strong resistance level. So it's very important that we see the market has halted the prior trend at this level, showing it's a very important or significant resistance level. And then the neckline break. The pattern is confirmed only when there is a clear break below the neckline. Otherwise, it's not a confirmed pattern, which is a horizontal line drawn through the lowest points of the troughs. For example, we can accept it as the neckline of this triple tops pattern. This break should occur with increased volume for a stock, indicating the sellers have gained control and a bearish reversal is likely. And for the let's say for the forex market, we don't have a real actual measured volume on the real time. So we can use some momentum oscillators like the RSI or MACD as you see here. Any selling pressure which is significantly changing the sentiment of the market usually results in dragging the RSI below the 50 level out of its neutral zone in the selling area below the let's say 45, for example, 50 or 45 level. And that's the sign that we can use for a confirmation. And also we know when the MACD bars are shrinking below the signal line is another sign of waning positive momentum, and we don't really expect that during a strong uptrend. So as soon as we see the drop of the MACD bars below the signal line, it means the market is correcting itself and we are somehow on the verge of let's say decelerating positive momentum into the market, and then we can expect the market to show the control of sellers by crossing MACD histogram from zero line as we see here. And we will discuss it in more details later. Don't worry about these confirmation rules, but it's really important to understand the psychology behind the triple top or triple bottom as well, and the pattern formation, and also the validation rules that should be applied to all of them. Because understanding these characteristics and validation rules is key to accurately identifying and trading triple tops. By waiting for clear confirmations such as a neckline break with increased volume somehow, or the signal from the momentum oscillators, traders can avoid false signals and position themselves effectively for a bearish market move. And also we have the triple bottom. Let me just briefly explain it because it's very similar to the previous patterns. A triple bottom is a bullish reversal pattern that indicates a potential trend reversal from bearish to bullish. And this pattern suggests that the market, after testing a support level multiple times, may be ready to reverse direction and start an upward trend. Like the triple top, the triple bottom is a powerful reversal signal. It reflects the market's inability to push prices lower despite several attempts. And it's more reliable than the double bottom because we see more attempts and more fails from sellers. So that can add to the odds of reversing the market. An example here, for example, we can find an Euro GBP weekly chart. Somehow we can name it as, let's say, again, it's not a textbook fashion example, but we can name it as a triple bottom here if we get this level as the market bottom here, and we see the first, the second, and the third attempt to breach this level, which all of them failed to do so. So it can be an example of that. And if you look forward, maybe we can get another a better example. Maybe, for example, we have here formation of a double bottom here. However, let's get back to our example and see if the rules about the uh, valid triple bottoms uh, are applied here. Okay, so the triple bottom pattern is characterized by three distinct troughs or bottoms that occur at approximately the same price level, separated by peaks or rebounds. So if we look at this pattern here, we can say, yep, somehow we can have it as an, let's say, it somehow fits our definition about the triple bottom here. So the presence of these three troughs indicates that the market has repeatedly tested the support level but failed to break through it, demonstrating a strong support zone. And if you want to break down the formation of the triple bottom, we can mention the first trough here or the first market bottom. The pattern begins with an initial low after sustained downtrend, which is another important factor we have to keep in mind at the beginning of identifying any of these patterns. See, at least we need some lower tops and lower bottoms in the market to identify this pattern like this, and we can then adjust or draw the second trend line here, and you see you can identify here downtrend. So first, a prior downtrend is uh, very imperative, and then uh, rebounds and as buyers enter the market. Then following the rebound from the first bottom, the price rises to resistance level at this uh, top, and we can also somehow adjust it to this level. This peak is the highest point, yep, between the uh, troughs, and helps define the neckline of the pattern. So the price then declines again, forming the second peak followed by a third trough, forming the second market bottom, and then we have another rise in the price, and then we see that it's followed by a third market bottom. Each decline sees the price reaching similar lows, reflecting persistent buying interest at this level. And the second top, as we mentioned, and third troughs decline to levels similar to the first trough, as you see here, indicating that the support is strong. Despite multiple attempts, it's very important to notice sellers are unable to push the price lower, showing that the selling pressure is weakening and the buyers are stepping in to defend this level. So this repeated defense of the support level sets the stage for a potential bullish reversal. However, to effectively trade a triple bottom, it's essential to confirm the pattern using specific validation rules, which the first one is symmetry. Again, all three troughs or market bottoms should be at approximately the same level. And this symmetry indicates a strong support level that the market has tested multiple times without breaking through, signaling persistent buying interest in the market. Then the pattern is confirmed only when there is a clear break above the neckline, which is a horizontal line here drawn through the peaks between the troughs. And when you don't have we have uneven, let's say, market tops, it's better to take the highest one as the neckline to make sure the breakout is more accurate. So this breakout should occur with increased volume for a stock, indicating the buyers have gained control and that a bullish reversal is likely in the market. However, in the absence of actual real-time, let's say, volume in Forex trading, we use RSI or MACD or any other momentum oscillators in the market. So Understanding these characteristics and validation rules is crucial again for accurately identifying and trading triple bottoms. By waiting for clear confirmation, such as a neckline break with increased, let's say, level of RSI or rising MACD bars above the signal line, we can avoid, again, false signals. So the definition, the definition, the formation, and the validation rules, which are all imperative to trade with this. Okay, so variations in double and triple tops and bottoms could be helpful. As we continue our journey to understanding these powerful reversal patterns, it's important to recognize that not all double tops, double bottoms, triple tops, and triple bottoms are created equal. So there's a variation. Let's first discuss some variations uh, of these patterns. In this most common forms, we have the classic double top and bottoms and triple tops and bottoms that we've already covered. These involve 2 or 3 peaks or troughs at approximately the same level, okay? That indicates strong resistance or support respectively. However, sometimes we encounter what we call extended double top and bottoms. These are patterns where the 2 peaks or troughs are separated by a more extended period of price action, adding more complexity and potential uncertainty to the pattern. Similarly, complex triple tops and bottoms involve additional minor peaks or troughs between the main 3, reflecting more intricate market behavior and potentially more noise in the signal. Understanding this variation is key because the market doesn't always behave in textbook fashion. Recognizing when a pattern is forming but deviates slightly from the norm can help us stay alert and avoid hasty decisions. And now let's talk about a common pitfall for many traders. We call it bull traps and bear traps. These are essentially false signals that occur when the price action appears to confirm a pattern, but then reverses sharply, trapping traders who entered prematurely. A bull trap typically occur in a bearish market. Here, the price might break above a resistance level, suggesting a bullish reversal and triggering buy signal. However, instead of continuing upwards, the price reverses and moves sharply lower. And this trap catches bullish traders who have entered long positions expecting a breakout. On the other hand, a bear trap occurs in a bullish market, and in this scenario, the price might break below support levels, suggesting a bearish reversal and triggering sell signals. But instead of continuing downwards, the price reverses and moves sharply higher, trapping bearish traders who have entered short positions. So, importance of recognizing traps. Let's discuss this. Recognizing bull and bear traps is crucial because they can lead to significant losses if not properly anticipated. Traps often occur when traders do not wait for confirmation or fail to consider broader market context, which can lead to premature entries and exits. Let's see if we can find a real-time example in the charts here. Something can be like this. For example, if we draw this trend line here. This is the uptrend line, and then we mostly see the market is struggling to get above this resistance area here by forming some tops and bottoms. And if you look at our textbook to validate this pattern, we see there is no symmetry in this pattern first. And also we see this uptrend line doesn't confirm the formation of the pattern by getting below the neckline at this level, which is the lowest low or the lowest bottom in this formation. And that means even when we have the confirmation from the RSI or MACD, which are both pointing south, but we see the uptrend line is still intact. So in this case, we see the market doesn't go further down, and we have a reverse in the price getting back to test the previous market top again. So this is what we call it a bull trap, which means we have a very weak valid formation of a double triple tops here, and then we have this bearish candle here as a sign of a neckline breakout, very clear breakout of our neckline, but the market doesn't continue this way. The only key to recognize in beforehand is looking at this, let's say, trend line here. Other that's why we really need to even when we have all the confirmation from the other indicators in the market, it's really essential to to set our risk management rules. Because even in case we have a very let's say somehow valid chart pattern, it might be a trap. So that's the that can point to the necessity of using or applying the risk management rules. Okay, and next, using multiple time frames is something that traders can better confirm patterns and avoid these traps, gaining a more comprehensive view of market trends and sentiment. And this approach helps validate signals and ensure that we are not merely reacting to false breakouts or breakdowns, but are making informed decisions based on robust analysis. Now that we've discussed the potential pitfalls of bull and bear traps and the different variations of double top and double and triple tops and bottoms, let's delve into a powerful tool that can help us avoid these traps and make more informed trading decisions. We name it multi-time frame analysis. Let's see, what is a multi-time frame analysis? This is a type of analysis that involves analyzing a chart pattern across multiple time frames to confirm its validity. Instead of relying solely on a single time frame, this approach provides a more comprehensive view of the market by examining different time frames. We can gain insights into both the broader trend and the finer details of price action. And the primary importance of multi-time frame analysis lies in its ability to give traders a broader perspective on market trends. By analyzing patterns across different time frames, we can avoid false signals that might appear convincing on a single time frame but don't align with the overall trend. So this method helps to filter out noise and ensures that we are making decisions based on a more complete picture of market sentiment. For example, a double top on a daily chart, let's say, might look like a strong bearish signal, yeah. But if the weekly chart shows a strong uptrend, the double top might just be a temporary pullback rather than a full reversal. By considering both the daily and weekly charts, we can better assess the strength and validity of the pattern. Uh, let's see how we can apply it and then get back to our MetaTrader for a real-time example. Begin your analysis with a higher time frame, such as the weekly or monthly chart. This gives you a sense of the overarching trend, I mean the bigger picture of the market. Are we in a long-term uptrend, downtrend, or are the markets sideways? This broader context is crucial because it sets the stage for how you interpret patterns on lower time frames. For instance, if the weekly chart shows a strong uptrend, you might be more cautious about taking short position than daily charts, the double top or unless or the triple tops. Unless it aligns with a broader reversal. For example, if we see the market is forming a reversal pattern in a shorter time frame, but in a higher time frame, we are at the verge of a let's say key level, like a very significant resistance level or a support level, which means uh, the higher time frame as a priority in our analysis. So we don't go through the chart pattern on the lower time frame until we see a clear breakout of that key level in a higher time frame. So this is a way. The final step afterward, let's say, uh, lower time frames provide the detail and precision needed for timing your trades, but these patterns should ideally align with the broader trend identified in the higher time frame. The final step is to confirm the pattern's validity by ensuring that it aligns across multiple time frames. Look for consistency between the time frames. If you spot a double bottom on the daily chart, check if the weekly chart supports a bullish reversal. This alignment increases the likelihood that the pattern is valid and reduces the chances of being caught in a trap. And then let's say multi-time frame analysis is particularly useful for avoiding bull and bear traps because it helps ensure the breakout or breakdown you're seeing on a lower time frame is supported by a broader market trend. So by incorporating multi-time frame analysis into your trading strategy, you can significantly improve your ability to validate patterns, avoid false signals, and make more informed trading decisions. This approach allows you to see the bigger picture while still being able to act on the specific signals that matter most. For example, here, let's go through a 15-minute chart to see if we can have something. If I zoom out a bit, this could be a beautiful formation of a triple bottom somehow. You see, it's not a bit a symmetric pattern, but it is something because we have this support level here, and we have the price forming this top or this let's say market tops here, and then we have a breakout above this market top. And if you go to a higher time frame, like a 30 minutes time frame, here again we can recognize at somehow a double bottom pattern, you see, which is a reversal pattern for us. However, also we have at this breakout level, we can see a break above the moving average, crossing above the moving average, breaking on this, let's say, long body candlestick. And also we have the RSI confirmation from the RSI and MACD, both of them pushing above the neutral zones into the buying area. So this is the confirmation from the higher time frame. And if we move again to our lower time frame, we can spot our entry here at this breakout level after breaking the neckline, which is accompanied with a breaking above the 100 WMA moving averages, and also somehow, let's say, uh, establishing the market movement above the 34 moving average, which is another bullish sign. And also we have the confirmation from the RSI MACD, which is here we see the MACD cross above the zero line, which is a bullish signal. Above the signal line, which is another confirmation for this bullish breakout. So, and this is a way we can let's say trade the for example this type of breakout. But if I move to 5 minutes chart here, it's very important. During this beautiful downtrend, as we see the market is forming the lower tops and lower bottoms, somehow if we ignore this one as a trap here, and then we see the market is trying to get below this support level here multi-time, but these long shadows here illustrate the price rejection by buyers. It means that the negative momentum is weakening in the market. And then we have the market testing this market top here. And again, if I point it out, you see at this level, we have this shadow here. And even though if I want to have a confirmation from the oscillators, I see the RSI and MACD are both confirming somehow this breakout on the 5 minute chart. For example, if we were on a live market, we don't have any idea about the following candles, okay? But let's at this level, so 16:15, look at the 15-minute chart. And here we don't have any confirmation from the higher time frame, as we see the RSI is hovering in the neutral zone, and also we have the MACD. It's above the signal line, but it's still below the zero, which means it's pointing in a selling pressure in the market, which is waning, but it's not enough to confirm this breakout here. And also we see the market is rebounding from this 34 100 WMA, which is another sign. And as long as we see the price between two moving averages, the short one and the long one, it means the price is acting sideways. So we don't have any confirmation at this point, but we have a very nice confirmation at this level, because the higher time frame is confirming the formation or the breakout of this neckline for us. And also, this is a way we can incorporate the RSI and MACD in our trades, as I discussed. So now that we've covered how to identify and validate patterns across multiple time frames, let's delve into specific trading strategies that leverage technical indicators to enhance the effectiveness of double and triple tops and bottoms. We will be focusing on two powerful tools, the relative strength index and the 34 linear weighted moving average here. To incorporate the RSI, we know RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and helps traders identify overbought or oversold conditions in the market. RSI is particularly useful in conjunction with double and triple tops and bottoms for confirming potential reversals, as I try to demonstrate it on the chart. And RSI helps us let's say, uh, helps us understand whether an asset is potentially overbought or oversold, or it's moving to selling area or buying area. With the RSI is above 70, is generally indicates that the asset might be overbought or it's in a very strong uptrend. So uh, signaling a possible a pause or reversal to the downside for the price. Conversely, with the RSIs below 50, it suggests that the asset might be in uh, under pressure and the selling pressure, signaling a possible reversal to the let's say again downside. And we have the same condition applied to uh, RSI in the buying area. For example, if you have the RSI getting back above the 30 level, it can be a confirmation for a bullish reversal pattern. Or if we have an RSI somehow getting above the 50 level or neutral zone, which is another interpretation of increasing positive momentum in the market. So one of the most powerful uses of the RSI is in identifying divergence. However, divergence occurs when the price of an asset moves in the opposite direction of the RSI. For instance, in the case of a double top, if the price forms two peaks at similar levels approximately, but the RSI forms a lower high on the second peak, this is known as bearish divergence. It indicates that despite the price reaching the same level, the momentum is waning, suggesting a potential bearish reversal. I guess you can find a good example of that here. However, let's move forward because we're running out of time right now, and then somehow we will demonstrate a real time example for sure. And the same thing is the same application we can use for identifying divergence on for a double bottom. So if the price forms two troughs or market bottoms at similar levels, but the RSI forms a higher low on the second trough, this is known as bullish divergence. So it indicates that the selling momentum is weakening, suggesting a potential bullish reversal in the market. Using RSI divergence as a confirmation tool can significantly increase the reliability of double and triple tops and bottoms patterns. So the RSI can also be used to confirm pattern reversals by looking at overbought and oversold levels. For double tops and RSI above 50 for double tops and RSI above 70 at the second peak can be a sign that the market is overbought, adding weight to potential reversal. And the RSI crossing below the neutral zone to the selling area is the confirmation for the formation of the double top. If we see simultaneously market breaking below the neckline, and for the double bottoms, an RSI coming back from 30 level at the second trough can confirm that the market is somehow oversold, supporting a potential bullish reversal. And we can confirm the pattern if we see the RSI moving above the 50 level into the buying territory when we have a breakout candle above the neckline. So the next, let's say, tool that we can incorporate in our trading with these patterns is the 34 linear weighted or weekly and somehow WMA, the linear weighted moving average here now. This moving average is a great tool for identifying the overall trend and can help in making informed trading decisions when trading chart patterns. It's really useful for confirming the overall trend of the market when the price is above. When we have a breakout, it's really important to see a crossing above a one moving average at least. For example, if you are in the daily chart, it's you can use a 34 WMA, which I have tested it for a long time, and it's really reliable indicator to those uh, valid chart patterns, reversal chart patterns. Because the moving averages can also act as dynamic support and resistance. And in the case of double tops, if the price fails to break above the 34 WMA during the formation of the second peak, it reinforces the resistance level and strengthens the bearish signal. Similarly, for double bottoms, if the price holds above the 34 WMA during the formation of the second trough, it reinforces the support level and strengthens the bullish signal. So this dynamic nature allows the moving average to adjust with the market, providing more relevant and timely signals. And also, lastly, using moving average crossovers can provide additionally entry and exit signals, because usually after a breakout in a very healthy chart pattern, we have a pullback to the broken neckline. So when a short-term moving average, such as the 20 MA, crosses above the 34 MA or 50 MA, it can be a bullish signal indicating a potential upward move. Conversely, when the short-term moving average crosses below the longer moving average, it can be a bearish signal indicating a potential downward move. These crossovers can be particularly powerful when they occur in alignment with a pattern formation like double tops or double bottoms, or triple tops and triple bottoms, providing a strong confirmation for entering or exiting a trade. So by incorporating the RSI and 34 a linear weighted moving average, not necessarily weekly, but on any time frame you use. If you incorporate these into your analysis, you can add an extra layer of confirmation to your trading strategies, and it for sure it helps to filter out false signals and increase the probability of successful trades. And here, now that we've covered the key concepts, patterns, and technical tools, it's time to bring everything together into a cohesive trading plan, a well-structured trading plan, which is essential for executing trades with discipline and consistency to minimize risk and maximize potential returns. So here are the steps we need to follow. So the first step in your trading plan is to identify the relevant patterns. It starts by using weekly charts to look for double tops, double bottoms, or triple tops and bottoms. The weekly time frame provides a broader perspective, helping you identify significant patterns that could lead to major trend reversals. Ensure that the patterns you identify have clear symmetry and are forming an alignment with the overall market trend. Secondly, you need to validate your pattern. Once you've identified the pattern, the next step is to validate it. This involves applying volume analysis, or let's say using the momentum oscillators to see if the pattern is supported by increasing or decreasing volume at key points. Such as the peaks or troughs. Additionally, use multi-time frame analysis to confirm the pattern across different time frames. For instance, if you have identified the double bottom on the weekly chart, then check the daily chart to ensure that the pattern is also evident and aligns with the broader trend, or vice versa. If you identify the pattern for our chart, so check the daily chart as well. And this helps filter out false signals and increases the reliability of the pattern. And also incorporate RSI and moving averages. With the pattern identified and validated, the next step is to incorporate technical indicators to spot the precise entry point, and like the RSI and 34 WMA as we discussed. Use RSI to check for divergence, bearish divergence for double tops and bullish divergence for double bottom, which it is a very, very reliable confirmation tool for all reversal patterns, and this will help confirm the potential reversal indicated by the pattern. Additionally, check the position of the price relative to the 34 WMA or other MAs that you prefer to use. If the pattern aligns with the overall trend direction indicated by the moving average, it strengthens the case for a potential trade. And remember, the 34 WMA can also act as dynamic support or resistance, giving you further insight to potential price movements. In the case you might have, let's say, the pullback to the broken neckline. And now let's talk about setting your entry and exit points. Entry points should be based on a clear break of the neckline confirmed by increased volume, or let's say confirmation from the momentum oscillators. For example, in a double bottom, you would enter a long position once the price breaks above the neckline, signaling the beginning of a potential uptrend. Conversely, and you have the confirmation from the moving averages, from the maybe trend lines as a dynamic support and resistance level, and also further confirmation from let's say momentum oscillators is a merit. So it's equally important to set stop loss orders to protect against unexpected market movements in case you are in the trap, because the nature of the forex market is unexpected. So for double tops, place the stop loss just above the second peak. For double bottoms, place it just below the second trough. This helps limit your losses if the trade doesn't go as planned. So the final and arguably most important part of your trading plan is risk management. Proper risk management is crucial to ensure that no single trade can significantly impact your overall portfolio. Excuse me. Let's start by determining your position size based on your risk tolerance. A common rule is to risk no more than 1 to 2% of your trading capital on any single trade. Next, set realistic profit targets based on the measured move, the distance from the peak or troughs to the neckline. This distance can be projected from the breakout or a breakdown point to set your profit target. And lastly, continuously monitor your trades and adjust your stop loss and profit target levels as the trade progresses based on market conditions. I can make sure that by following this structured approach, you can create a trading plan that is both disciplined and adaptable, allowing you to capitalize on market opportunities while effectively manage risk. So the key is to combine the identification and validation of patterns with the use of technical indicators and robust risk management strategies. Now let's analyze the USD JPY-H4 chart, focusing on the formation, confirmation, and target projection of the double top pattern here. Okay, let me first make sure that everyone can see my presentation, my screen. That's clear. That's great. Thank you. Okay, good. So let's continue. First, the first peak labeled as market top 1 represents the initial high in the price after an uptrend. So this peak marks a point where the buying momentum begins to slow and sellers start to take control, causing the price to pull back slightly to this level. And then we have a pullback to the neckline. After reaching market top 1, the price declines to a support level, which is marked on the chart as the neckline. And this level acts as a temporary support, and the price finds some buying interest here, preventing further decline as the at this point. And then we have the market top or the second market top. The price then rebounds from the neckline and moves back up toward the level of first market top here. It reaches a similar high at market top 2, as we point out here, indicating that the price failed to break above the resistance level established by market top by first market top. And this second peak at a similar level confirms the double top formation. And now the double top pattern is confirmed when the price breaks below the neckline. As shown in the chart, this is a critical signal that indicates the reversal from an uptrend to a downtrend. So in this case, the price breaks below the neckline with a strong bearish candle, which is typically a good sign of increased selling pressure into market. So let's look at the RSI in absence of any volume indicator in Forex. The RSI indicator at the bottom of the chart shows a bearish divergence if you check it out. For example, if I draw a line here from that bottom to this, you can see the divergence while the price is making almost the same top. So as the price reaches the second peak, we have the market top 2. The RSI is lower than it was at the first peak, so at the first market top, indicating weakening bullish momentum. So additionally, after the neckline break, the RSI moves below 50. Let's look at this here. Yep. It confirms the bearish reversal as well. And also, let's take a look at the MACD. The MACD indicator also confirms the bearish reversal as the price breaks the neckline. The MACD, excuse me, the MACD line crosses below the signal line, and the histogram turns negative, further supporting the bearish outlook as we see here. And also, we can point out a divergence between the price and the MACD oscillator here. As well as we have the oscillator decelerating with forming a lower tops while the price is making almost the same tops. So let's discuss the minimum projection here. The chart shows the minimum price projection at this level, if you see, which is the target price derived from the double top pattern. This target is calculated by measuring the height from the neckline to the peaks, market top 1 and market top 2, as you see here, and projecting that distance downward from the neckline break. And it's going to be the minimum price projection for this pattern, which is the market has achieved that very fast. The chart indicates that after the neckline break, the price continues to move downward toward the minimum price projection level, reaching or exceeding it. And this movement confirms the effectiveness of using the double top pattern for setting profit targets. So this chart of USD JPY in the H4 time frame illustrates a classic double top pattern with clear formation, confirmation, and target projection. The pattern forms with two peaks at similar levels separated by a pullback to the neckline. So confirmation comes with a strong break below the neckline supported by RSI and MACD signals indicating bearish momentum, and the target is set based on the heights of the pattern and is achieved after the breakdown, validating the use of the double top pattern for predicting trend reversals and also setting profit targets. And now let's analyze another example, the gold daily chart, focusing on the formation, confirmation, and target projection of the double bottom pattern this time. The double bottom pattern begins with the first trough at the price level of, as you see, 1675.98, And this trough occurs after a sustained downtrend where the price of gold falls and reaches a low point. This initial trough marks a temporary support level where buying interest begins to emerge, causing the price to rebound slightly to this level. And following the first trough, the price rebounds and rises to a resistance level known as the neckline, which is labeled on the chart as around the 1755.87 level. And this rebound indicates a temporary shift in momentum of the sellers to buyers. And after failing to break above the neckline resistance, the price declines again to a similar low as we see here, forming the second bottom around the same 1675.98 level. And this second trough retests the support level established by the first trough and shows that sellers are unable to push the price lower, indicating strong buying interest and potential accumulation at this level in the market. Now we have the neckline break. The double bottom pattern is confirmed only when the price breaks above the neckline at 1755.87 as we have here. And this breakout is a critical signal indicating a potential reversal from a downtrend to an uptrend. So in the chart, we can see that the price breaks above the neckline with a strong bullish candle showing increased buying pressure and confirming the pattern's validity. So while the chart does not explicitly show volume data, for sure, typical confirmation for double bottom would include a noticeable increase in volume. We know that during the breakout above the neckline especially, but this volume surge suggests that a breakout is supported by strong market participation, as we have this bullish Marabuzu here as our breakout, let's say, candlestick, reducing the likelihood of a false breakout. And also, instead of volume, we can use RSI and the other momentum oscillators to confirm this breakout. We see the RSI at the bottom. Yep, sorry. Yeah, something went wrong. Okay, yeah. Yeah, we see the RSI again formed a divergence with the price, and that's a very clear signal of weakening downward momentum. At the bottom of the chart shows bullish confirmation. Not only this divergence, but also crossing above the neutral zone when we have this very nice long body breakout candlestick. And also we have the MACD confirmation. The MACD, or moving average convergence divergence, also confirms the bullish reversal for us. As the price breaks above the neckline, the MACD line crosses above the signal line and the histogram turns positive, further reinforcing the bullish outlook. So for the target projection, again, the chart shows the minimum target projection, which is the target price calculated based on the double bottom pattern. This target is determined by measuring the heights from the neckline to the troughs, or let's say the market bottoms, and projecting that distance upward from the neckline breakout point. That can give us this level 1835.76. And after the neckline breaks, the price of gold continues to rise, moving towards the projected target level at $1835.76. And the price movement towards this target level illustrates the effectiveness of using the double bottom pattern for predicting trend reversals and setting profit targets. So this daily chart of gold illustrates a classic double bottom pattern with clear formation, confirmation, and target projection. And this example effectively demonstrates how we actually can utilize and trade technical analysis and chart patterns like the double bottom and the let's say double top alongside indicators such as RSI and MACD to identify and capitalize on market reversals. Okay, that's all from my side in this session. And as we come to the end of today's webinar, I want to thank each and every one of you for joining us and actively participating in this session. I hope you found this session on trading double and triple tops and bottoms, as well as using RSI and the moving averages like 34 WMA and 100 WMA, both insightful and practical. So have a great day and happy trading. I hope to see you in the next webinar.